Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are a wealth management firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, May 18th, 2026 edition. Let's get started. Investment values fluctuate on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means we keep your money invested in the areas that we feel offer the best prospects for growth, instead of trying to time the market. We focus exclusively on traditional investments of stocks, bonds, and cash. So we'll analyze fluctuations in the stock market and interest rates to help drive our overall investment decision process. We'll start with the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. And despite a pullback here on Friday, as well as no clear resolution to the conflict in Iran or lower oil and gas prices, the stock market still managed to gain 2.47% over the past 2 weeks, and that gives us a year-to-date gain of 8.22%. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. We believe interest rates are the preeminent measure of investment risk. Rates are factored into every investment calculation, including stock valuations. Generally speaking, lower interest rates will lead to higher stock prices, and higher interest rates will lead to lower stock prices. We also will look at high yield corporate bond spreads to give us a glimpse into some probability of default calculations for companies that issue debt to finance their operations. Most medium term and long term interest rates were up over the past 2 weeks. We've got interest rates listed over here on the left-hand side. Maturity lengths for bonds issued through the U.S. Treasury Department here on the bottom. So each of these dots represents an interest rate for a given maturity length. Brown line is where we were 2 weeks ago. The green line is where we finished on Friday. So again, meaningful increases in most of these long-term, medium-term, long-term interest rates. The short-term rates, again, pretty much unchanged. As far as the U.S. 10-year Treasury, this is kind of the flagship that we pay attention to. We thought maybe it had peaked here around 4.43% when we saw declines a couple weeks ago. That obviously got blown out of the water here as we are approaching 4.6% on a 10-year Treasury. And one of the big reasons we look at the 10-year is because it's most closely related to mortgage rates. And if these rates are going up, then chances of real estate market recovery will go down. We're pretty close, maybe a few pips away from where we were a year ago coming out of the tariff tantrum. And so I would see this as a potential opportunity for President Trump to do something that would ease the markets and have interest rates come back down. But we'll see if that actually happens. It's still amazing to us to know that we went from below 4% here around 393 for a 10-year Treasury now to almost 460 in just 2.5 months. And again, this is right when the war started with Iran. So current Trump administration policies, we believe, directly impacting where interest rates are at the moment. As far as the spread on high yield corporate bonds, so this is how much more interest a corporation is going to pay above and beyond the 10-year Treasury or Treasury rate. We're not seeing any signs of distress. You know, we did here in March as the war was in full force, but ever since the ceasefire was announced, even though the Strait of Hormuz remains closed, we're in a very entrenched downtrend on corporate spread. So no signs of distress. We don't feel like the probability of default is giving us any indications here. Strait of Hormuz is effectively closed. Right, we were averaging somewhere around 100 oil vessels going through the strait on a daily basis, and we're basically down to single digits here and have been ever since that war started. As far as oil prices are concerned, we've been kind of volatile, to say the least, but I'd say we're probably averaging around $100 a barrel, even though we closed at 105 on Friday. It's been fluctuating around that $100 a barrel mark for the past couple months, and we're off the highs that we saw beginning of April. Gas prices seem to have settled somewhere here around $4.50 a gallon on average. So even though it's a high level, it's something we haven't seen since 2022, when the Russia and Ukraine war started. Um, but it's at least settling at this point. Again, we're hoping that we see some news. Maybe we get more of these tankers going through the Strait of Hormuz, and we can start to see an end to that conflict and getting back to some sense of normal. But again, with the summer driving season starting with Memorial Day in a week, we're not anticipating gas prices will come back to a comfortable level until Labor Day or beyond. So that's kind of where we're at this point. All right, for our expectations and implications portion, earnings have been really good. First quarter earnings for these companies that are reporting have been good, and that's the main reason why we're seeing the stock market continue to rise. So as long as companies continue to generate more revenue, more profits, the stock market should be fine. If we can get a resolution to Iran, if we can get the Strait of Hormuz open so that energy prices and gas prices, other costs that are factored into the earnings that companies are reporting, we should see even more upside to the stock market. The analysis that I keep hearing is if that happens soon, that we would see positive reaction in the stock market. But I'm not getting a lot of firm dates on soon. So I don't know if that means this week, this month, or, at what point does it become a problem where the stock market finally decides, hey, uh, we need to take some profits and have another correction because things aren't um, shaking out the way that we were expecting them to? Or, what are some of the other risks out there that we're not even factoring in at this point because we're so focused on Iran and the Strait of Hormuz? So those are the things that would keep us up at night trying to figure out what the game plan would be if something else were to come this summer that we're not anticipating. As far as interest rates are concerned, we did talk a little bit last time about the 2-year US Treasury and how closely it moves with the federal funds rate. So again, the Fed funds rate, every 6 weeks they meet and they set an interest rate that is an overnight and lending rate that banks charge each other, right? I don't want to go too into the weeds, but it's not anything else. It's not, they're not setting an interest rate that we pay on credit cards or auto loans or home loans, but it is a benchmark interest rate that the banks and other lenders are using when they're trying to calculate how much they're going to charge on those other debt instruments. So something that's very fascinating. If we look at the 2-year US Treasury bond and we look at the Fed funds rate that they set every 6 weeks, we can see it's very similar, right? This is over the last 40 years. Blue line is the 2-year US Treasury. The white line is the Fed funds rate. And these red bars are US recessions. So typically we see rising interest rates and then declining interest rates that lead into a recessionary period. The 1990s were a little different. We were able to go up and down for a decade without incurring a recessionary period. But again, we typically will see a rise, a flattening out of that interest rate, and then a decline with a recession. So we saw that here in the late 80s, early 90s. Saw it again in the dot-com bubble bursting, again in 2008 financial crisis, and then again with COVID. So, interesting case study is whether or not we would have ended up in a recession anyway if COVID hadn't happened, but it did. So that we blame that on the recession. But very interesting for us to kind of look back at the 1990s and wonder are the 2020s going to resemble the 90s? Like, will we be able to have the Fed funds rate and the 2-year Treasury kind of go up and down and fluctuate and maintain some sense of stability for an extended period of time before we have some kind of an economic recession? So To be determined. But typically, the 2 year is going to lead the Fed funds rate. So we see the 2 year rising, and we'll see uh, the Fed funds rate go behind. And then we raise too far, and the 2 year will lead us down, and the Fed funds rate will follow. Dropped it to near zero here in the financial crisis, trying to provide a floor, which it effectively did during President Obama's term. And then President Trump gets into office, and we see interest rates going back up with the economic growth. We're, trying to not allow things to go too far too fast or the economy to be too hot. And then, of course, COVID shuts things down. We go back to near zero rates. And then all the stimulus, all the inflation that we had back in 2022, we saw the fastest increase in the Fed funds rate that we've ever had, at least in the last 50 years. And then, we've kind of been above that 2 year, again, letting the 2 year guide us over the last couple years. Now, if we had not had this war with Iran, we would have anticipated another 0.25% decline in the Fed funds rate at a meeting in March. But the 2 year has reversed course. So now it's going higher than where we currently have the Fed funds rate. So there's a lot of debate, a lot of discussion whether or not the Federal Reserve is going to leave rates unchanged, if they're going to increase them next, or if the new Fed chair, Kevin Warsh, is going to come in and still cut rates, which is what President Trump has been calling for and what everybody's concerned about. If inflation is picking up and interest rates are moving higher in anticipation of higher inflation, if the Federal Reserve cutting interest rates would cause more problems. So we think there's a meeting here in June. We don't think there's going to be any move. We think this is within the acceptable range of fluctuation that a lot of what we're seeing in inflation reports and economic data that's coming out that's not super fantastic is because of higher oil prices, higher gas prices, basically, the whole result of this war in Iran. And if we can look through that, if we can get past the current policy issues, that those inflation numbers should come back down. The 2 year Treasury should come back down, and we can see the Federal Reserve cut interest rates as well. So that's kind of where we're at with all of that, and those are our expectations. But we're getting into a summer season, which is going to be interesting, and we'll just keep paying attention as best we can and reacting to uh, any changes to policy that might need to either buy more of what's working or put some measures in place to get out or decline, not decline, but reduce our positions if we feel like things are heading in a different direction. All right, as a final word, I occasionally get people asking me what to do with extra income. They change jobs, they have some inheritance, etc., and they are looking for ways to maximize growth for whatever extra cash that they have. So we put together a little list of some ideas of things to consider. This is not necessarily um, advice. This is just some ideas. So having a 3 to 6 month emergency fund, which in our experience hasn't necessarily been for emergencies per se, but we tend to see this more for clients who end up going in between jobs. Either they get let go from a job or they choose to leave, and then they can have some flexibility if they want to take a hiatus or a sabbatical and they kind of want to do some introspection and decide, what do they really want to do with their life before they go get another job. Like they can have uh, several months that they don't have to worry about working and they can live off that emergency fund. Look at your 401k and consider contributing the maximum, not just to get the maximum on a match, but you can put in over $20,000 a year. So if you've got extra money, that's a good way to allocate into a retirement account. You can look at paying off high interest debts. We tend to look at the interest rates on the credit cards or mortgage, student loans, et cetera. And if you have a higher interest rate on a debt, then you can feasibly get investing in the stock market, then you can consider paying those off because you're ending up losing more than you would potentially gain if you are trying to invest. You can put several $1,000s into a health savings account, which is also uh, beneficial for paying for medical expenses, especially in retirement down the road. If you are eligible, there are some income requirements, but Roth IRAs are another good way to put money aside. And then finally would be into an individual or a joint account, a trust account. Um, those all have different tax treatment than the retirement accounts. So again, not advice per se. These are some suggestions. There's a lot to consider. And so if you have extra income, if you want to have a conversation, we can give some one-on-one advice. But in this case, these are just some suggestions that we came up with. But final note, we will be off for the rest of the month on an extended family vacation, and the next newsletter and video will be June 8th. So it'll be a few weeks before we get back to that. So other than that, hope you have a good week, and we'll talk to you soon.